Welcome to Investors Insights. Our topic today is Rise Together. The reason we chose that topic, and we just finished a great meeting, it's because several of you have been asking about rising interest rates in relation to the stock market. We're going to give you insight on that today, a lot of detail. I'm joined by my distinguished colleagues, Bobby Norman and Ty Miller, and the debate was excellent today as we analyzed portfolios in relation to our clients' financial blueprints. So with that, Bobby, I'd like to go to you first. You showed us a great chart, which I've really enjoyed going back through the different years. Explain that, give us insight how the stock market works in relation to rising interest rates.
Yeah, so coming into the month of September, we talked about how it's usually the most volatile month of the year, and history repeated itself as the S&P 500 was down over 5% for the month. And one of the biggest drivers of the volatility in September was due to rising interest rates as the 10-year Treasury yield rose from 4.1% to end the month up to 4.57%. And obviously, the rise in yields occurred in part due to expectations that the Federal Reserve will keep rates higher for longer. And so while the fear around higher rates has spooked the markets in the near term, as you can see in this chart, over time, stocks and interest rates actually usually rise together. Interest rates and stock valuations tend to be inversely correlated in the near term. And while that relationship does tend to hold for shorter time periods at elevated rates, as you can see in this chart, the S&P 500 index tends to rise throughout sustained periods of rising interest rates. So looking at periods of rising rates since the early 1960s through this year, you can see on the right-hand side of the chart that only 3 of the 14 periods of rising rates led to lower stock returns. And the return through these periods shows that the market has averaged 16.3%. So yes, rising rates lead to shorter term volatility, but over long time periods, stocks and rates usually rise together. So even if rates stay high or go higher, it doesn't mean stocks will stay down. So something we looked at over the weekend, obviously the short-term volatility due to rates. So something we'll continue to look at.
Yeah, and there's no guarantees, as you said, Bobby, but it's great to look at this historical data for us to kind of navigate through the present. And so I thought that was excellent insight on your part. Really enjoyed the research discussion. And Ty, you jumped right in there in terms of a continuation to talk about yields. Elaborate on that and tying in what Bobby just said.
So I have a nice chart, showing where we were in 2007 and where we are now. And so why is 2007 relevant? Well, that was the last time that yields, the 10-year Treasury yield was over 4.5%. And so as you can see in this chart, we've come a long way since then. S&P 500 was at 1541. Now we're over 4,200. You can kind of see the similarities of oil. $87 a gallon, now 91. You can see that Bitcoin didn't exist. Of course, we have, the largest weighting Exxon compared to the largest stock now is Apple and how they're weighting and the largest sectors. So it's always interesting to see, for me, to kind of go back in history and just see that, we kind of made this big circle on, at least in terms of yields and what that looks like back in 2007. With that being said, I do have another topic as well to kind of address. I kind of spent all weekend getting ready to talk about a government shutdown, and lo and behold, the unexpected averting of a shutdown as the government was able to work out a deal. Kind of the headline that we have here is Congress averts a shutdown for now. So we think this is kind of a 45-day thing at least. It could go longer, but just kind of puts that hold on for 45 days. It was very unexpected. The odds of a government shutdown were approaching a near certainty, but they were able to get a bipartisan package through. Legislation includes $16 billion of disaster aid, excludes border funding and Ukraine aid. We think kind of the next step here is that Speaker McCarthy, his speakership will kind of be a little bit challenged, but right now that's just kind of speculation based off of everything that has happened. Not everyone was for this deal, of course, but enough people were to kind of get through this. And then, as I said, I was expecting to talk about the government shutdown. So I do have some charts to share. Typically, stocks are not correlated at all with government shutdowns. As you can see, there's some up years and some down years. GDP growth as well has very little correlation. Actually, we have a lot more up years than down years as far as that goes. Each government shutdown, of course, is a little different. Now we have a lot of workers on strike. We have higher gasoline prices rolling off of consumer aid, along with picking up on student loan payments. But typically, when you're looking at these things, while they are a lot of headline risk, the actual results necessarily don't match that headline risk. And so I think that's something to keep in mind. But I definitely wanted to share about the government shutdown today, as that's going to be the big news.
Yeah, and thank you for doing that, Ty, because folks, what you've just seen here is that we listen to your feedback, your questions. Rising interest rates in relation to the stock market has been a big theme and question. In addition to that, our clients were concerned about a government shutdown. We've been researching that. We're always trying to be proactive and ahead of the curve as to what we need to bring you up to date on. We have a list of what we call threats to the economy that we are prepared to address or navigate through, take action on in our portfolios in relation to the financial blueprint. So we are constantly talking about these topics, researching them. We're sharing them on our social media, on Facebook, Twitter, LinkedIn, YouTube, our podcast. The fact that you have continued to share that information with family, friends, and colleagues means a lot to us. We thank you for doing that. It's opened up doors and opportunities for us, and it's a huge vote of confidence and trust that you have in us. And we thank you for that. So we're going to keep you updated about rising interest rates, stock market, possible government shutdown, and other topics. Keep in mind, today is October 2nd. In 90 days, we will be in 2024. And there's a lot of activity and things that are going to take place over the next 90 days. And we will be there ready to answer your questions and have discussion. And every day, we want you to live a better, richer, fuller life. Have a great week. We'll be in touch.